Good morning, everybody. Welcome to today's webinar, Tax Cuts and Jobs Act, an individual tax update. My name is Matthew Latham. I'm a senior manager here in the tax department at Costerisan. Today's topic is basically looking at the individual tax impacts of the Tax Act that was passed towards the end of last year. We'll kind of take a look at some general impacts, discuss some of the rate changes, some of the deduction changes, some of the dealings with loss carry forwards, and we'll end the day with some of the state tax changes and impacts that have occurred over the last year. Starting off on December 22nd, 2017, President Trump signed the Tax Cuts and Jobs Act. Most of the provisions went into effect as of 1/1 of this year. However, there were some exceptions that you need to be made aware of dealing with mortgage debt as well as depreciation for those of you that have businesses that flow to your 1040. Another important distinction that I'm going to mention now that doesn't get mentioned throughout the presentation, but I'll try to remind you, is that these individual provisions generally do expire after 2025, whereas the corporate provisions that they put in place, such as the corporate tax rate cuts, do not expire. So the individual ones generally do, corporate ones do not. There was a lot put into this bill, some of which was to try to make filing your 1040 a little easier. Of course, when the government decides to try to make our lives easier, sometimes they throw in a few curveballs that we have to really kind of dig into. Some of the clear-cut changes, the individual tax rates have changed. Most of them have been reduced. The alternative minimum tax, the effect of it has been minimized to an extent. The individual health insurance mandate has been changed. That's after 2018. And then there have been changes to your standard deductions, your exemptions, your itemized deductions. And one of the bigger changes was that the estate, gift, and generation skipping tax exemptions were doubled from $5 million to $10 million. If you own a business, whether it's a Schedule C, a Schedule E, or you have a pass-through S-Corp or partnership, understand that there were some changes there as well that you'll actually see on your 1040. Biggest one is probably the 199A deduction. We actually had a webinar earlier last month, I believe it was, that just focused solely on the 199A deduction because there is a lot to that. We'll kind of touch base on it, talk about a couple of things, but I don't want to get too stuck into the details, otherwise we'd be here all morning. NOL changes were big, and interest expense limits have gone into effect for certain taxpayers. And then there were some state tax concerns, which the state of Michigan has actually fixed, that I'll get into, one of which was your personal exemptions accidentally just went away because of the federal tax law change. So each individual state kind of had to look to see what they needed to do as a result of this bill. For comparison's sake, here are the individual tax rate changes. These brackets are for single taxpayers. You'll see on the left the 2017 tax law. The rates went from 10% all the way up to 39.6%. The 2018 tax brackets, again, start at 10%, but you see pretty much every other tax bracket has been adjusted or been changed for a single taxpayer, going all the way up to 37%. For married filing joint taxpayers, you have the same tax brackets in 2017 from 10% to 39.6%, and those have been changed to 10% to as high as 37%, and you'll actually see that the tax brackets themselves, the dollar amounts, have been adjusted slightly as well. The other filing methods that I don't get into, such as like head of household, married filing separately, they also had these changes. I just wanted to kind of show the two bigger ones that we generally run into. More comparisons between your tax return for 2017 to 2018. The standard deduction has almost doubled for single taxpayers and for joint taxpayers. The compromise to this, though, is that your personal exemptions have been eliminated, so that in 2017 you got a $4,050 exemption for yourself if you filed a joint return for your spouse, if you had kids, for them as well. And those have all been eliminated. For high income earners, that was less of an issue because those exemptions got phased out. However, I know for a lot of taxpayers, that's going to be something that's a little bit of a surprise. Capital gain rates basically did not change. This was another big thing. The 0% rate, 15% rate, and 20% rates still apply, depending on what your tax bracket and what you end up falling into. The other thing is the Health Care Act, Obamacare Act, net investment income tax is also still out there, the same 3.8% rate. Some of the high kind of big picture changes, we'll get into some of these a little bit later. For itemized deductions, medical expenses, if your AGI is over 7.5%, it stayed. That was actually potentially going to get eliminated. One of the big changes, especially for probably a lot of our clients, or pretty much anybody that has to pay state income tax as well as property taxes, is that your state and local taxes are capped now at $10,000, which I know for a lot of people that's going to be a pretty big deal. Benefit to that is that now AMT, which did not allow those deductions, should become less of an issue, or hopefully will become less of an issue for you, because now you don't have as big of a deduction. And then the other trade-off of this is that with the rate changes, the reduction in your rate is supposed to make up for the reduction in your deduction. The mortgage interest now has been changed. We run into this every now and again, especially if you have multiple homes. In 2017 and before, if you had more than $1 million in debt, your mortgage interest expense was actually limited. The new law is capped at $750,000 of debt. Is now your mortgage interest starts to become limited. This is only on new mortgage interest or new mortgage debt acquired after December 15th of 2017. Home equity interest has been completely eliminated. The limits on your charitable contributions have actually gone up. This is specifically for cash donations or non-cash donations that aren't subject to other limitations. And the 2% itemized deductions and the miscellaneous deductions are now gone, which again, this was another thing that under AMT could potentially get thrown out anyways. So the Congress's hope is that by simplifying Schedule A, you're going to see less of an AMT impact, so in turn you're going to see a drop in your taxes. As I've mentioned now a couple of times, the AMT exemption has changed to the point where the exemptions have been increased, again, to try to capture fewer taxpayers. Under the old tax laws, your itemized deductions potentially could have gotten phased out if your AGI was too high. That is now gone. There is no phase out for your itemized deductions. And then one other mention with alimony, if you happen to be divorced and paying your spouse alimony, it is no longer deductible on your 1040. It is also no longer income to your spouse. And then for those of you that get the child tax credit, it did get expanded. It was a $1,000 refundable credit. Now it's a $2,000 credit per child, of which $1,400 is refundable. Plus, they've also added a $500 credit for non-child dependents. So if you happen to be taking care of like a parent who's living with you, an older parent, or another relative that potentially would qualify as dependent, you actually do get potentially a $500 credit for that. And they've also increased the phase-out limits, so that way they try to get more people the credit. Some miscellaneous items, just because we've seen some of this stuff, especially recently with hurricanes that hit the East Coast and hit the South. Personal casualty losses have been eliminated unless it's a federally declared disaster area. And then another potential big thing is that the individual health mandate, meaning the penalty on your 1040, has been reduced to 0. However, this doesn't apply until 2019. So the individual mandate does still exist for 2018. Now, for those of you with business entities on your 1040, whether it's a Schedule C, Schedule E, whether you have a partnership or an S Corp that comes through, you could potentially qualify for a 20% deduction on what they call qualified business income. This is the 199A deduction. There are exceptions to this. If your business is a specified service, meaning involved in health, accounting, financial services, law, broker services, you do not get this deduction, or you start getting phased out of this deduction if your income gets too high. If your business is not one of those industries, you are subject to other limitations, such as W-2 limitations and like what they're calling qualified property limitations if your income starts to get over 315. So again, in general, it's a 20% deduction off of your qualified business income. If you're a service industry and you're under the 315 threshold for a joint return, or half that for all other taxpayers, then you get the deduction regardless. And if you're not a service industry, you get the 20% deduction without the W-2 or property limitations. And this deduction is taken on your 1040. Now, I will note, though, that taxable income is potentially another limitation to the amount of deduction you can take, because you can't create a loss with this on your return. So the taxable income thresholds to worry about the limitations, again, starts at 315 for married filing jointly. You get fully exposed to the limitations if your taxable income exceeds 415,000, or half that for all other filers. This is a reduction of taxable income. If by chance you were familiar with the domestic productivity deduction, or DPAD as we commonly called it, it kind of acts in a similar fashion, other than the DPAD was a page 1 deduction on your 1040. This looks like this is going to be a page 2 deduction after AGI and after itemized deductions. If you don't have taxable income, you don't get the deduction, since you can't increase your losses with it. Also, as I mentioned, if your taxable income gets too low, then the deduction will get capped. So the big question then is what is a qualified trade or business? The term basically means any trade or business other than a specified service business, or the trade of or business of performing services as an employee. One common tactic was thought that was going to happen was that, especially if you were in a specified service, is that basically you'd have an attorney that works for a law firm, and then they would actually, quote, quit their job, but then get rehired as an independent contractor to try to get the deduction. Well, the IRS is already onto that and has said that basically if you're doing a job basically as an employee, even though you're technically an independent contractor, then they're going to disallow the deduction. So again, their specified service is any business activity involving the performance of services by employees or owners, specifically in those fields. A big one that is not on here is engineering. We've had many engineering individuals ask us about it. Engineering is specifically left off. We guess that their lobbying firms were a little more powerful than the AICPA, because accountants are on this list. The other big one is any business where the principal asset of the business is your reputation or skill. Now, this caused a lot of concern that a lot of service providers were going to be disqualified from this, because, I mean, people usually will hire you because you have a good reputation or a unique skill to provide. But the IRS did come out and say that they're actually trying to narrow the scope of this. And the common example that we've seen is that if you have, for example, like a celebrity chef who owns a restaurant, people might go to the restaurant because of the name of the celebrity. However, that business is actually there to provide food, so you're actually going there for the food. Therefore, the restaurant would qualify. However, if the celebrity were to endorse a product and sell that product, then that would be a specified service, because now people are buying the food or whatever based on the reputation of an individual. Losses. If you end up in a loss position, or if you already have a loss in place, the NOLs were impacted. The good news is that if you already have a loss in place, if you have an NOL carry forward from an earlier tax year before 2018, nothing has changed for you. You can still take that loss. That loss is subject to the limits of the old law, which means you can only carry it forward up to 20 years. There is no taxable income limitation on that loss, so that is good news for anybody that might have a loss still in place. For future losses or anything starting after 2017, you cannot carry it back. You have to carry it forward. It is subject to an 80% of taxable income limitation. So for example, if you have a $100,000 loss and then in 2018 and then in 2019 you have $100,000 of taxable income, you're only going to be able to take $80,000 of that loss. So it kind of puts you in a taxable situation regardless of what happens. The $20,000 that you weren't able to take, you are still permitted to carry that forward. One potential benefit of new NOLs is that you can carry them forward forever, so there is not subject to that 20-year limit. Not that we've seen people on 1040s run into a 20-year limit issue. There is another layer of loss limitations that I call the active loss rule. The IRS is actually calling it the excessive business loss rule for 1040s. So basically, if you have a loss and you file a joint return and it's over $500,000, you're only going to be permitted to take $500,000 of that loss, and then the rest is carried forward like an NOL. So hopefully nobody runs into this situation, but if you do, then that is there. So it is another layer of loss limitations. If you are single, that gets reduced in half to $250. So if any of you have passive losses that you have to deal with too, this is basically in addition to that. But basically, I've called it an active loss rule just because usually those are the losses that you can actually deduct on your return. And as I said, old NOLs are still permitted and still follow the old rules. So there's no 80% taxable income limitation, and you do have to utilize it within 20 years of it being created. Another subtle change for those of you that have children that file tax returns, whether they have just started a job or whether you've set up some investments for them, the kiddie tax rules have changed. Under the old law, we basically would have to wait until the parent return got completed because the kid's investment income was taxed at the parent rate. Now, to try to simplify it, what the Congress has done is they've actually set it so that if your child has investment income and they're a dependent, they're going to be subject to the trust income tax rates, which generally speaking is much less favorable, is actually going to expose them to potentially get more tax. Now, this is dealing with the income that is taxed at your ordinary rates, not your capital gain rate. So do keep that in mind. But this was done to try to simplify the tax code, but it also puts them in a situation where, like, that interest income, short-term capital gains, or ordinary dividends now are going to be taxed actually at a higher rate than they otherwise would have been, again, if they have enough. So it's just something to be aware of, something to keep in mind as you file your kid's tax return come 2019. Home mortgage changes. Acquisition debt is now limited to the first $750,000 for debt acquired after December 15th of 2017. Old acquisition debt is grandfathered in. Home equity debt, either way, interest is now completely disallowed. This is personal interest. So if you have a home equity loan out there, you might want to look at seeing if you want to refinance it. Obviously, don't just do it because of taxes. I mean, obviously look at interest rates, especially if they've gone up. Then it might not make sense to actually do it, because then you might put yourself in a situation where you're going to be paying more in interest than you would get in tax savings. But just be aware that the home equity debt is now disallowed. The interest expense is now disallowed. So then it's just talking about your acquisition debt on your home or your secondary home, should you have it. As I mentioned earlier, to me, the biggest change is the state and local taxes deduction. It's not just income taxes either. It's limited to $10,000. You may remember that when this first came out, a lot of people in, quote, high income tax states, such as California and New York, were complaining about this. Then one thing, though, that we always mentioned is that you don't have to necessarily be a high income tax state. Michigan isn't considered a high income tax state. However, it doesn't take much to get over $10,000, especially if you're filing a joint return and both spouses are working. It's pretty easy. And then you add your property taxes on top of that, or if you have just, say, a main home and then you have a cabin or vacation home somewhere else, it really doesn't take much to get over $10,000. So that does get limited. Again, your medical expenses is subject to a 7.5% floor. Charitable deductions now limited to 60% of your taxable income. The biggest change here was more dealing with college athletics. If you donate to, say, Michigan State or Michigan, and you want those football seats and you have to pay that, a few $100 premium on the seat for the right to buy tickets, you used to be able to get a portion of that as a charitable deduction. That has now been disallowed. So one thing I will mention, though, is that you can donate. It's specifically for the rights to purchase seats. So there are potential ways to, quote, get around that, but that would be looking at maybe donating to the academic side of the school, maybe donating to just a general fund on the athletic side. That way, it's not tied to actually the purchase of seats. So that is something to look at. Also, the IRS is saying if you have a charitable deduction of $250 or more, it needs to be substantiated. Anything less than that does not need to be substantiated. And then if you do run into the limitations, the excess doesn't just go away, it just gets carried forward. And then the last item here, as I mentioned earlier, is that the phase out for itemized deductions for high income earners is now gone. This is potentially a big one if you fell into this category. I have a feeling, though, that a lot of the stuff up above, especially with like the state and local taxes, the phase out would be less and less of an issue. The alimony deduction, again, has been repealed. The one thing I didn't mention before that I'll add here is that this is specific for divorce instruments executed or modified after 2018. So if you already have one in place, then you should still be able to get the deduction. Kind of I don't want to call it a minor change, but with the moving expenses, you used to be able to get a deduction for moving expenses, moving to a new place, a new location for a new job. That has been repealed unless you are a member of the armed forces. And as I've mentioned once already, the child tax credit has been expanded. The phase out piece has been increased to $400,000 for married family jointly, or for $200,000 for all other taxpayers. So you can see a lot more taxpayers could potentially qualify for this, and the credit is actually much more friendly. It's a $2,000 credit, of which $1,400 is refundable. And then again, they added the $500 credit for non-child dependents. This was one of the compromises that they came up with when they felt that they were going to start limiting people and their deductions, especially for lower income earners. They wanted to give them something that maybe they weren't getting from the tax rate changes. So this was one of their compromises that they came up to actually get the bill passed. For those of you with businesses on your 1040, something to look at. Now again, this I think is going to potentially impact more for pass-through entities, but because there is a $25 million gross receipt limitation, and chances are your Schedule C and your Schedule E isn't there. However, there are control group concerns. So if you have multiple businesses, this is something that you own. This is something that you might need to be aware of, because then you have to take a look at all the businesses you own, see if you're over that $25 million threshold. This could potentially pull in any pass-through entities that you might have too. So it's just something to look at. It is basically your business interest would be limited then to 30% of your taxable income. Any excess or anything that gets disallowed does carry forward. But like I said, I have a feeling for most of our 1040 clients that have just a standalone Schedule C, a standalone Schedule E, or maybe one or two, you're not going to really need to worry about this. This is going to kind of more come into play for those of you that have multiple businesses or multiple pass-through entities, and I just wanted to mention it. especially if you weren't able to attend our business tax change webinar. 199A deduction should be reviewed. If you haven't asked already, or if we haven't asked already, then that discussion should be had before the end of the year. What can we do to make sure that you qualify for this? Because that, to me, is a big one. That was kind of a compromise thrown to those people. Again, C Corp's got a big tax cut down to 21% from 35%, so they wanted to throw. They were aiming for pass-through entities such as partnerships and S corps, but if you do have a Schedule C or Schedule E, this does also apply to you. So if you don't have a partnership or an S corp, don't worry, this should still be looked at. Another under the radar change was that now entertainment expenses have been disallowed. You were normally allowed a 50% meals and entertainment deduction. The entertainment piece of that has been fully thrown out. So something to look at in your own records is make sure the entertainment piece, if you happen to entertain clients, gets broken out separate from the food, because your meals are still deductible at 50%. The other thing to potentially consider is the entertainment something else. Keep in mind the IRS is quote onto it, so that they don't want to see people trying to play games. Professional fees is something also to look at. I know for some clients, if you split your professional fees, such as our tax prep fees, between your Schedule A, Schedule C, Schedule E, that's fine. Schedule A is now gone. The IRS doesn't want to see you now playing the game of moving everything over to Schedule C, Schedule E just to get the deduction. If you've always done it a certain way, and there's actually a reason to keep doing it that way, then you should keep doing it that way. If there's a reason to change it, you just need to substantiate it, because if the IRS were to come calling, I have a feeling that might be a low-hanging fruit for them to try to pick at, just because they're going to see that all of a sudden, you know, if you had $500 on your Schedule C and $1,000 on your Schedule A, now it's been flipped around, they're going to ask why, and then potentially disallow something there. So the IRS is very keen that people are going to poke the bear, I guess, to see what they can kind of get away with. And you don't want to be the one that accidentally wakes it up. Kind of shifting gears a little bit here. There were some unintended consequences of this tax law change. One big one was the state of Michigan exemption for 2018 was eliminated. Basically, the state tied the personal exemption on your state return to the federal exemption, so that when the federal exemption went to zero, by default, the state exemption also went to zero. The state did realize that was a problem. They didn't want to accidentally create a tax increase for the entire state, so they did fix this earlier in 2018. This was more of a 2017 issue, is that the IRS was going to disallow prepayment of taxes if it wasn't for that tax year. So we know some people would try to prepay all of their 2018 taxes and all of their 2018 estimates in 2017, knowing full well that the $10,000 limitation was coming through. So the IRS has basically said that in 2017 it was only deductible if the tax was basically a real number. So it wasn't intended to capture the fourth quarter estimate that would have been due in January of 18 if you happen to prepay that, because that was actually a real tax that was basically assessed to you. Same thing with the property taxes in Michigan, at least, that are due in February. A lot of taxpayers would prepay those. It wasn't intended to capture those. What it was intended to do was people would actually try to prepay their summer 2018 taxes in December of 17, and the IRS basically is saying, no, you couldn't do that. Another interesting trick that actually state governments tried to do, California, I know, did this. I think Illinois tried to do something similar. California actually set up a charitable trust to pay your state income taxes, to try to get around the state income tax limits, so that basically you were making a charitable donation to the state. The IRS basically said, nope, it's a substance over form issue. You're paying your state income taxes, therefore it's a state income tax, and that's what the deduction should be. So the substance over form issue is always a big one to get over. I guess we can give California some credit for trying to be creative with that, but just again, if you get too out there with trying to play a game, like I said, you don't want to be the one that accidentally wakes the bear up. Another potential impact, this is really for everybody, in the sense that if you like to purchase things online, you might notice that you are starting to pay a sales tax more and more. If you own a business and you have out-of-state sales, this is also something to pay attention to that could greatly impact your sales taxes. Basically, very recently, this fall, the U.S. Supreme Court ruled that you no longer needed a physical presence in a state to be subject to sales taxes. They used what was called substantial economic nexus. Basically, what South Dakota did was that they realized they were losing a lot of money to online retailers that had sales in the state, so they passed a law to try to capture out-of-state businesses that were selling inside the state. Basically, they said if you had $100,000 of sales or you had 200 separate sales transactions, you have what they call substantial economic nexus, therefore you have to pay sales tax, or you have to remit sales tax. This got challenged, and the state of South Dakota actually did win in the Supreme Court, so this was a major change to the sales tax rulings that have been around for quite a while. Michigan established basically the same standard as of October 1st of this year, so that again, if you own a business and you have out-of-state sales, or if you're outside the state of Michigan, I should say, and you have sales inside the state of Michigan and you meet those thresholds, you do have a sales tax issue that needs to be addressed. For our Michigan clients, understand that every state now has basically established or will establish their own rules. When I went back last night and looked, there was something like 30 to 35 states had established some standard, most of which were the $100,000 of sales or 200 separate sales transactions. A few actually had a higher threshold to get over. There were a couple that had a smaller threshold, though, especially in the plain states. I think Oklahoma was one that had about a $10,000 sales threshold. So it's just something to look at and be aware of, especially if you sell out of state. You definitely need to review it. So basically, what should you do is that we should sit down, discuss any types of filing obligations you might have, determine what is taxable in the state between products and services, because every state can have their own rules. It's also something you need to look at the potential state tax exposure, including any historical exposure that might exist. In Michigan's case, the law is, as I said, is effective as of October 1st and there wasn't any retroactive piece to it. I actually believe one of the big things of the Supreme Court case was that there shouldn't be any retroactive piece to it. The problem you're going to run into is if a state passed a law, say in 2016, establishing the standard that has now been upheld by the court, then you might need to go back and look at 2016, 17 just to see what you might have. And then obviously the need for any prospective compliance that you might have here coming up in the future. It's always important to get in front of it. There is obviously, a cost concern. If you end up having to pay $10 in sales tax, then it might not make sense to actually file. It might make sense to just kind of wait and see. But again, it's always good to look at it just to make sure that you don't end up on anybody's wrong list. Some tax reminders that I always like to mention, and we still see this to this day. In fact, we're actually seeing that these calls seem to be getting more and more aggressive to try to scare people, is that the IRS or any government agency will not call you to collect taxes unless you have already established contact yourself. They will not send you anything through email. So if you get an email that says you owe a bunch of money, delete it, don't click on any links. Basically, I've had many clients say that they get these phone calls and it's frightening. They make it sound believable. And I know there's a lot of people that are skeptical and say, oh, they'll never fall for that, but you'd be amazed how tricky they can get and how smart some of these scammers can be. So again, the IRS or the state or any government agency will not call you directly to collect taxes. If they say you have to pay it off in prepaid cards, that should be an immediate red flag. That is not the way that the government usually accepts payment. So again, when in doubt, try to collect their info, hang up, contact your tax advisor, or actually, go look and contact the actual government agency itself to see if this is real. I mean, understand, and this is something especially to talk to any older relatives that you might have, because they tend to try to target people that, older individuals that might want to say that it might be easier to trick, because I've actually had people of all ages, unfortunately, fall for something like this. But, it's a good idea to always remind people, again, they will not call you. If you get anything in the mail, they will send you stuff through the mail, but obviously, if you're not sure, then contacting tax advisor is always a great way to go. And one thing that you'll probably hear, and this is usually where they get people, is they'll tell you that if you don't, they're going to call the police and have you arrested, which that obviously will frighten a lot of people. But again, you can always try to get off the call by either one, just hanging up, or two, just say, great, let me get your information, call you back, and then they'll probably give it to you, and then you can hang up, and then at that point just ignore it. Going forward, then at least you're off the phone. So very, very important. This is not a new thing. This has been around, but it's always, to me at least, important to remind everybody. Identity theft through tax filings is unfortunately getting more and more common. The federal government and the state, they do have programs in place that if you believe somebody has filed a return using your Social Security number, the IRS actually doing a really good job with their PIN program. We've noticed a lot of individuals, especially in medical fields, seem to be targets for this more than other people, but you'll get a letter that says, we have received a return, but we need more information. Therefore, you have to usually send in copies of your W-2s, proof of income, and then the IRS will actually take a look and see. Or you could tell them right then and there that you didn't file anything if that's the case. And then that'll stop them from issuing the refund to the wrong person. We actually had a client one time get a refund check, and it turned out that the scammer sent it to them accidentally. So the scammer wasn't very smart there. But that's also important to know that if you get a check and you weren't expecting it, don't cash it, because that can create a problem for you too. And unfortunately, we've had that happen before, where somebody will get a check, they'll just cash it thinking, hey, I got a refund. But if the refund's a different amount, it's always good to compare your bank account, if you have a direct deposit, to the actual tax return, just to make sure that you're getting what you're supposed to be getting. The state has a similar program. The state will also ask for more information to be attached to the return, and they will try to use your spouse's Social Security number and your kid's Social Security numbers at times, so be very careful with how you store that information and who you're giving that out to. And if you have any inkling that an email is an odd email, it's always good to give the person a call just to see if they really sent it. It's better to be over careful than just trying to send confidential information electronically. Better safe than sorry. With that, we've hit the end of the webinar. I end this with one of my favorite Peanut comics that I frequently have, I guess, I've shown if you've ever been to any of my other presentations. If you have any other questions and you want to reach out to me, there is my email right there on the screen. Feel free. I usually check my email quite frequently. And with that, we'll conclude today's webinar. I appreciate your time, appreciate your attention, and thanks for attending the webinar.